To MMBBA. First of all, I want to welcome everyone for taking the opportunity to attend this event today. We have a special guest with us today, Jim Hall from Freddie Mac, who's going to definitely share with us a wealth of information. My name is Catherine Kramer-Dale. I'm with the State of Maryland Department of Housing, and I'm here today to do a brief presentation about the Maryland Mortgage Program. But I want to also just thank you so much for getting onto this call and supporting the Maryland Mortgage Bankers and Brokers Association. As you can see, when you become a member or you link on to our website, we have so many education classes that you could participate in, from learning how to navigate your credit, with learning how to pick the right loan for your customer. So many opportunities for you to learn. Please look at the link. Make sure you get on our website, MMBBA, to make sure you can see if you, we'd love to have you join. It provides a huge wealth of information. It's agents and lenders and brokers. So please participate. I only have about 20 minutes to talk because this is about an hour and I'm sharing it with Jim. So I want to make sure I just touch on a few important components about the Maryland Mortgage Program. Our website is www.mmp.maryland.gov. And when you're on our home page, you'll see it's predominantly yellow. You'll scroll to the right and it says Professional Portal. One thing I want to show you most importantly is we do, under our training component, have PowerPoints. Yes, there is a PowerPoint all about the Maryland Mortgage Program, how a borrower is eligible, all the different programs that we have to offer. I'll touch briefly on them in the 20-25 minutes that I have. We also have a very extensive PowerPoint on the famous Maryland Smart Buy 3.0. So definitely, again, I'll touch briefly about it, but here are actual PowerPoints that you can dive into and that are constantly here as a resource for you. I'm going to hit the back arrow. I'm going to get back and I'm going to scroll down. I'm going to pass this big yellow box. You'll see a man with a pair of glasses. It says Program Information. You're going to click on Learn More. Now, I know that I may have a lot of different people attending this. It could be a broker. It could be an agent. It could be one of our approved lenders. But I just will share with you, if you have a client that reaches out to you that could be a possible candidate for the Maryland Mortgage Program or is interested in using the Maryland Mortgage Program, you have to actually make your application through one of our amazing approved lenders. We have about 120 lenders. They're all my partners. They're amazing people to work with. A lot of our approved lenders are part of MMBBA. So again, when you join MMBBA, it's a great opportunity to network and learn. When you're on this site, I want to first of all show you our interest rates. You can sign up for these interest rates at the bottom of the screen. When you subscribe, it'll ask you for your email address. I would personally sign up to receive these rate sheets. They're generated at 10 o'clock every day. It's like a cheat sheet. It tells you how our rates are performing, which you'll see there's not that much of a huge fluctuation. And it'll also show you the different products that we're offering that could be a benefit to your client. We also want to point out to you that you don't have to be a first-time home buyer to use the Maryland Mortgage Program. In the past, you did, but you don't anymore. On the left-hand side of our rate sheet, these are called our first-time Advantage products. You'll notice that the rates are lower on the left-hand side, but you do have to be qualified as a first-time home buyer. There's 3 products: the First-Time Advantage Direct, the First-Time Advantage 5,000, and the First-Time Advantage 3% loan. On the right-hand side, it's literally the same products, but we're calling this product line the Flex. This is where you don't have to be a first-time home buyer. I could literally come to you and say, I currently own a home, and with COVID, I want to get near the water. I need to buy a place near the beach, or I need to get near the water, maybe in Annapolis, or maybe somewhere in Baltimore County off Middle River, wherever. If I currently own a home, as long as I agree to sell my current home, because with the Maryland Mortgage Program, you cannot be on a deed or have interest in any property anywhere in the world. So if I'm agreeing to sell my home because I want to purchase this new dream home near the water, I can still use the Maryland Mortgage Program. I just have to stay on the right-hand side of the rate sheet if my lender cannot in any way, shape, or form determine that I'm meeting the first-time home buyer guideline. The rates are a little bit higher, not by much. So again, even though we're providing you that flexibility, the rate isn't really that high. The same three products are on the right-hand side that were on the left-hand side. First Time Advantage Direct is the same exact product as the Flex Direct. The First Time Advantage 5000 is the same product as the Flex 5000. The First Time Advantage 3% loan is the same product as the Flex 3% loan. And then you'll notice there's two additional products on the right-hand side of this rate sheet that are grants, 3% grant and a 4% grant. I'll briefly go over these with you, and then I'll go to the specialty products. The First Time Advantage Direct and the Flex Direct, they are actually very popular. One of the reasons why they're popular, and I'm going to start off, especially with even having Jim Hall on the call, is we have a great relationship with Fannie and Freddie. And if you are doing any one of our conventional loan products, any one of these, the reason why this product is so appealing is even though your borrower is not getting any down payment assistance from the Maryland Mortgage Program, they are benefiting from the lowest rate that we have on our rate sheet. But the state of Maryland Department of Housing is a housing finance agency. And one of the benefits by going with us is that you could possibly take advantage of getting an HFA discount on your MI. When I talk to loan officers every day, again, because I was a loan officer for years, I say, hey, listen, you're going to run your AUS. And when you go in, you're going to put in what your qualifying income is, not our household, the qualifying income that you're using. And it's going to tell you what your AUS findings are. It's going to tell you what your percentage of mortgage insurance is. Well, you need to stop for a minute. If you're doing one of the Maryland Mortgage Program loans and it's a conventional product, you could very well take advantage of getting the HFA preferred discount on your MI. What is that, Catherine? Well, when you go on Fannie or Freddie's website, they have an area median income chart. And when you look at the chart, if your borrower's qualifying income is below that 80% AMI, woo, it will blow your mind. You could take advantage of a discount on your MI from a 35% to an 18%. So the reason why a lot of loan officers or lenders are using this First Time Advantage Direct or the Flex Direct, they may not be getting any money from us because the borrower may not need it. They could be tapping into a very low rate, but they could take advantage of getting a reduced MI. And again, that's through the HFA preferred, and that's us. The other two products are called our First Time Advantage 5000 and the Flex 5000. And I'm going to lump this other one right in there with it. It's called the First Time Advantage 3% loan and the Flex 3% loan. These are loans. These are the rates, of course, for the first mortgage, but this down payment assistance for the amount of $5,000 or 3% of your total first mortgage, which includes MI, these are recorded as second liens. This is money that your borrower has to promise to pay back when they either sell or refi. Obviously, the rates on the left-hand side are a little lower than the right-hand side. This $5,000 here, you pay it back when you sell or refi. It's in the form of down payment and closing cost assistance. With this $5,000 product, you can take advantage of our partner match. Yeah, we are not only partners with our approved lenders, but we also are partners with employers, builders, developers, local communities. So if your borrower is buying a house from a particular builder, or they work for one of these many, we have hundreds of providers of employers on our partner match directory list. When you go on there, you'll see, and I can briefly show you, when you go in here to partner match, and you see all these different partners that are on here, if your borrower could take advantage of getting funding from that partner, the state of Maryland Department of Housing, there's the employers, home builders, community organizations, and local governments. If your borrower works for this employer, if they're going to give you $500, the state of Maryland's going to match $500. So now your second lien with the state would be $5,500. But you could get $3,000 from your employer. We are only going to match up to $2,500. So with this $5,000 product, and as you can see, we've got prominent hospitals, we've got city, county, states, we've got colleges and universities, we've got, RE/MAX, we've got, Royal Dining Services. I mean, there's, Shepherd Pratt, several city, county, state employees, a plethora of employers that you can select from. So when you're in here and you're back to professional portal and you come back under here and you go to rate sheets, we're right back where we started. This $5,000 product is the only one that you can tap into the partner match. So you could get a maximum of $7,500 from the house keys for employee, and there could be an additional amount of $1,000 for smart keys. Well, look at this first time Advantage 3% loan or the Flex 3% loan. Notice that the rates are exactly the same as the $5,000 product. These are both recorded as second liens. Well, the difference is this first time Advantage 3% loan has actually become very popular. In fact, most lenders are using this instead of using the $5,000, is because it's 3% of your total first mortgage. So if you're doing a loan and it's $188,000 or higher, of course, 3% of that total first mortgage could very well benefit your borrower by getting more than $5,000, $75,000, or even $8,500. So the first time Advantage 3% loan, you round down, no change, and it could actually be more of a benefit to use than our standard $5,000 product. Again, these are recorded as second liens, and this is money you have to pay back when you sell or refi. On the right-hand side, these are our grants. These are winner, winner, chicken dinner. These are products that the borrower does not ever have to pay back the down payment assistance. Yes, you'll notice that the rates are a little bit higher. When you're comparing it to the 3% loan, if you look at the 3% grant, this is not recorded as a second lien. It's 3% of the total first mortgage, round down, no change, 4% of the total first mortgage, round down, no change. And you do not have to pay the money back when you sell or refi. None of these products that I've just discussed with you have any required seasoning time. So it's not like you have to stay in our product for a certain amount, a year, 2 years, 3 years, whatever, and then it's forgiven. No, this second lien money is never forgiven. It's not deferred. It doesn't go away. This grant money is not recorded as a lien. It's free money right out the door. When your borrower comes back to you to say that they'd like to see if they could refi, you can, and you don't have to pay the money back. Underneath here, again, we have a couple specialty products. Our Montgomery County program, I would imagine, is going to be coming back July 1st because we run off of a fiscal year. So our year starts July 1st. Keep your ears and eyes to the pavement. The Montgomery County Homeownership product will more than likely relaunch itself. It's a down payment assistance where Montgomery County has come to the state of Maryland and said, we want to help promote people to buy in Montgomery County. Their DPA portion last time they did this product was $25,000. Yes, it was in the form of a recorded lien that the borrower had to pay back, but purchasing in Montgomery County can be challenging because of the higher values. So it's a great product to help you get into your first home or to purchase a repeat home. We have the Home Mobility product. This again is only available to our top performing lenders. It doesn't have a lot of funding with it, so I won't lie and tell you it probably equates to maybe 18 loans max. But this will also come back effective for our fiscal year, so keep your ears and eyes to the pavement. It's currently closed as well, but it should come back. This is for someone who is disabled or caring for a disabled family member. The conventional refi product, look at that rate. It's not that great, but hey, I'm the state of Maryland. I'm not here to be doing refis. This product was originally created because in 2009 and 10, when we were all dealing with a very high foreclosure, a lot of our borrowers that have the second liens were upside down and they couldn't refi to get out because again, you got to pay this money back when you refi. Well, even now, if you refinance out of our DPA loans and you are not in a position to pay that money back, we don't like to subordinate. We want you to pay it back. So if you're in a position and this rate right here is actually a benefit to your borrower, you could refinance within us with our conventional refi, and we will subordinate that second lien. Now for the Maryland Smart Buy 3.0. And I know I don't have that much time left because I again want to share it with Jim, but we have the Maryland Smart Buy 3.0. This product is amazing. It does have 3 moving parts. It is a first-time home buyer product. You have to be a first-time home buyer. You have to have student loan debt. You have to have at least $1,000 of student loan debt. It is a Fannie Mae product, and it's a conventional only. It is designed for a borrower that wants to purchase a home through the Maryland Mortgage Program, and they do have to be a first-time home buyer. But here's the deal. The first mortgage is a 95% conventional. Standard regular conventional loan. Yep, you can take advantage of getting possibly that HFA reduced MI as well, because it's our product, it's a conventional loan. Well, the second lien, the second recorded lien is optional. If your borrower needs money, we have a $5,000 DPA that if they want it, they can add it. If they don't have to. So again, you've got your first mortgage 95 conventional, you've got your second mortgage, which is optional, which is the 5,000 DPA. You're not looking at a high combined loan to value. Now with the Maryland Smart Buy 3.0, because the combined loan to value is not really high, you can use any MI company to order your MI. You're not required to go through Radian or Genworth. Well, the student loan portion. You would ask your client for all of their student loan debt, Sallie Mae, Great Lakes, all of it consolidated. And you would say, okay, you've got $37,000 worth of student loan debt. When you leave the closing table, all of your student loan debt has to be paid off. The state of Maryland will pay off 15% of the purchase price up to a maximum of $30,000, whichever is less. We pay that off. If your borrower owes more, they have to be in a position to pay it off as well. They could get a gift. They could borrow it off their 401. They could even go get a personal loan, and then your loan officer would just count that in the DTI. But when you leave the closing table, you cannot have any remaining student loan debt. What's really cool about this Maryland Smart Buy 3.0 is that 15% of the purchase price up to a maximum of $30,000, whichever is less, that student loan portion that we paid off, it is not in the form of a secured lien. That's why you don't have a high combined loan to value. It is actually in the form of an unsecured promissory note. With the Maryland Smart Buy, you do have to stay in our product for a designated time. It's a 5 years. If you leave within the first 5 years, then that is deferred 20% for each year. So that student loan portion would have to be paid back, 20% deferred over 5 years. But if you stay in the product for 5 years, poof, it's forgiven. Every product that I just discussed with you today, when you hit the back arrow, we have collateral and fact sheets that are available. You can click on any of the collateral and fact sheets to see the products. If you ever have any questions, you can always feel free to reach out to myself. My name is Catherine Kramer-Dale. So that's CATHERENE.KRAEMER-Dale, DALE, at Maryland, MARYLAND.gov. Certainly feel free to email me. I do conduct trainings all day and every day. So generally, I'm not able to get back to you until about 3:15. But I promise you, I'm old school. I'm going to pick up the phone. If you give me a phone number to call you, I'm going to call you back and answer any of the questions that you may have about originating, processing, underwriting, closing, post-closing. Here's our point of contacts if you ever have any questions. This single family housing email address, certainly always feel free to reach out to this email address if you have any questions. They will always assist you or direct you to the person that can. In order to be eligible as a first-time home buyer, just really quick, and to be eligible for our programs, there are 6 questions that you would ask yourself. Number 1, am I a first-time home buyer or not? So you know what side of the rate sheet you're going to be on. In order to be eligible as a first-time home buyer, It's either A, never owned a home, B, hadn't been on a deed in the last 3 years, C, a veteran using our VA entitlement with us for the very first time, or D, buying a property in a targeted area. The second eligibility guideline is household income. We have income limit charts where you would go on here. You would see what the income limit chart is. You would open it up. Our income limit charts are very generous. These are all 6 figures. So this is not for low to moderate income as well. The third eligibility guideline is our assets. We have asset requirements. Your borrowers cannot have more than 20% of the sales price in order to qualify for our program. We only use liquid assets, checking, savings, CDs, stocks, bonds. We don't look at whatever you have in your 401 or retirement. The fourth eligibility guideline is homebuyer education. All the borrowers have to take homebuyer education. When you're looking at our link for homebuyer education, it will guide you as to the borrower taking it in a housing counseling agency, which I believe they're probably going to start offering classroom settings. If not, they're currently still doing Zooms. But on here, you will see, here is a list of our housing counseling agencies. We also have them online. Shoot, do your class in your pajamas with a cup of coffee, and the borrowers have to take it, not homeowners. But please note, for loans purchased on or after January 1st, 2021, Fannie Mae issued guidance that acceptable homebuyer education must also be approved by HUD or an NIS. MMP does not review for compliance with Fannie Mae requirements, but it can impact. So we want to make sure that your borrowers are taking a HUD approved or an NIS homebuyer education, either in a classroom setting or a Zoom or Microsoft Teams, or online in their pajamas with a cup of coffee. The last 2 are our DTI. Number 5 is our DTI. A standard is at a 45%. And then the last one is our credit score. Our credit score guidelines are at 640. Here's an amazing product matrix chart that will show you each one of our products is outlined. Roll up here. I got a couple more minutes before Jim comes on. This product matrix sheet is a cheat sheet. It shows you, here's the first time Advantage Direct, and it breaks it down, conventional, FHA, VA, USDA. So it tells you the credit score is 640. It tells you none of the products require 2 months PITI. And across the board, our DTI is at 45%. But I want to point out, on any of our products, if you are doing a conventional and an FHA, we will allow you to go up to 50%, but your credit score has to be at 680 or higher. So again, this is the first time Advantage Direct, broken down conventional, FHA, VA, USDA. The next set of products is the first time Advantage 5000. There's the 3% loan. There's the home mobility. Here's the Smart Buy. Notice it's a little different. This one does have a higher credit score. It's at 720, and then etc. Here's all the different programs. This was a basic review just to give you some ideas about coming to the state of Maryland Department of Housing and using our amazing products to help you guys with your clients. I understand it was very brief. We do trainings with MMBBA once a month. I believe we're going to start back up again on the second Tuesday for July. So again, please reach out to MMBBA, come on the website. We'd love to have you be a member. I want to thank you guys that are currently using the Maryland Mortgage Program product. If you ever need any assistance, you know how to find me. For those of you that are currently not, I would love to have an opportunity to do any trainings for you as a lender or any of your staff. These are great products. Now I'm going to turn it over.
Catherine, we've actually got 2 questions for you. We're going to ask real quick.
Okay.
The first one is, if we do the MMP 4% grant, are you saying there is no seasoning time at all, but Smart Buy you would need to stay for 5 years? So if using the grant, a consumer could then refi 3 months later to a different rate.
Okay, not 3 months later. You're definitely going to want to make sure you're following your agency guidelines, and you're definitely going to want to reach out to your management, because at the end of the day, as well as you guys sell the loan, all of our approved lenders have to sell all of the Maryland Mortgage Program products to our final investor which is US Bank. So I believe standard guideline is 7th payment, 210 days for you to refi. And you would definitely want to reach out to your management and find out what your EPO is on that. But yeah, with these products here, the grants, any of these products, there's no designated time from Maryland Mortgage Program for you to refi. Definitely check out with your management to make sure you're meeting agency guidelines. And yes, the Maryland Smart Buy is the only product where we have a designated 5-year required seasoning time. If you stay in the product for 5 years, poof, it's forgiven. If you leave within the first 5 years, it is deferred 20% each year. Hopefully that answered your question.
All right. And our next question was coming from Crystal Smith with Genworth.
Hi, Crystal Smith.
Hi, Amanda and Catherine. I actually was just raising my hand so I could tell Catherine there was a question in the chat box. So I don't have a question. Thank you so much.
All right.
Thank you.
Well, perfect. Then with that, we can go ahead and turn it over to Jim.
All right.
Perfect.
Thank you. Catherine, that was a great presentation. We are here at Freddie Mac very proud to partner with your housing finance agency and promote the Maryland Mortgage Program. So great job.
Thank you. The same as well.
And I will share my screen now. Can everybody see that? Okay. All right. Amanda, I'd like to thank you for giving me the opportunity to speak to your members at the MMBBA and also your board of directors. I also like to thank them for providing this time. My name is Jim Hall. I'm Affordable Lending Manager with Freddie Mac. I focus on business development strategies and partnering with housing finance agencies up and down the East Coast. So my region is from Maine down to Florida and also including Alabama. I've been with Freddie Mac for 3 years in this position. Prior to that, I worked at the New Jersey Housing Hfa up here in Trenton. And so I have a real soft spot for housing finance agencies, and that's probably why Freddie Mac hired me. That I was an assistant director in the single family division, and really helped the underserved and workforce families for many years, and really became my passion. Prior to that, I was on the private side in the lending industry for 20 years. I've been doing this since 1986, so I'm kind of showing my age here. And so I've seen all sides of the the industry, so I really have a good understanding on it. And I did distribute a copy of this PowerPoint to everybody that was on the email distribution list on the invite. If you weren't on that list and you want a copy of this, you see my email there. It's james_hall@freddiemac.com, and I would be happy to send you a copy of this presentation if you find the information valuable and you would like to use it as a resource and tool. First place I'd like to start is, what is Freddie Mac? I mean, everybody here is Freddie Mac, Fannie Mae, and I get a lot of questions out there in the market. What do you really do? Well, first of all, we were created and chartered by Congress as a government-sponsored enterprise in 1970. So we celebrated our 50th year in business last year, which we were very, very proud of. And we operate in the secondary market. We're a mission-based organization, and our primary mission is threefold. We promote liquidity, stability, and affordability in the housing markets. We also have community missions. And right now, one of our main community missions is to bridge the homeownership gap between white, non-Hispanic homeowners and people of color. And I'll address that more in depth later. We have 3 main business lines: single family, which I'm part of, that's 1 to 4 unit properties; multifamily, which is 5 and more; and capital markets. We have 4 main pillars to our business. insights, education, mortgage products, and business solutions. We have a really strong data and analytics team that provides us research studies and information for our housing partners to use, in setting their strategies. Part of my presentation today will illustrate that to you. I will do a market analysis for you for Maryland, and you'll be able to see, the type of information that that they provide to, employees like me in the field to share with you. We also provide mortgage products. We have many, many mortgage products. On the affordable side, you probably either heard of or use Home Possible. The product that we use with housing finance agencies like Catherine's is the Hfa Advantage Program. We also are very, very strong in education, and that is really twofold. Okay, it's educating the industry, our housing partners, and also consumers. Financial literacy is key, and we're finding that the younger generations who are becoming the new home buyers, really aren't becoming financially literate in high school or even in college. I can remember back, when I was in high school, my senior year, we had business math, which readied us to, budget, balance a checkbook. So there's no harm in, learning what a debit and credit is and being able to, really, keep your finances in check. And also, our fourth pillar is business solutions. We provide a lot of services, resources, and tools, really at no cost for our housing partners to use. And at the end of my discussion, I will, go over, one of our main business tools, which I think is very, very, very helpful, in our industry. I always love this chart that they created for us. This kind of puts the affordable ecosystem into perspective. When a home buyer, enters into the arena of, buying a house, it can be very, very overwhelming for them because there's a lot of hands involved. And, we put this chart together to try to put it in a better perspective. As you see on the top, there's loan officers and real estate professionals. And why are loan officers and real estate professionals on the top? Because really the genesis of the transaction, starts there. The home buyer, can go to a realtor, or, they may have been, referred to a loan officer who then refers them to a realtor. So getting them off on the right foot is really, really imperative, for their financial well-being, especially on the affordable side right now. We have so many challenges in the nation, as you all know. The affordable inventory is very low. What is out there, sometimes is a little banged up and needs some help. And, with especially a first-time home buyer, a lot of them don't have a lot of cash assets to really help them, achieve the American dream. And that's where, housing finance agencies really come into play, because they, offer great down payment assistance programs that, that help those home buyers. So, and if you look at the bottom of this chart, we have housing finance agencies. They essentially are working like in a secondary market also. Housing finance agencies are like mini Freddie Macs, essentially, by providing programs to lenders out there in their communities. So why does Freddie Mac work with housing finance agencies? So it's really important to put it into perspective what a housing finance agency is. They can be an instrumentality of government. They really came out of Lyndon Johnson's vision in the 1960s, which was called the Great Society. Now, Johnson and his administration were really known for the civil rights legislation and the Voting Rights Act, which he signed in 64 and 65. But a lot of people overlook the Fair Housing Act, which was signed in 1968, which was there to promote, affordable housing and affordable lending. With that being said, Johnson's administration knew they couldn't do it all on a federal level. So that's why they took it to the states to start, promoting this. And housing finance agencies started being created through the 1960s, 1970s, and 1980s to help, support the affordable housing needs. My old alma mater, New Jersey Housing, was created in 1967. So, we came out of that wave. And Freddie Mac also, as I mentioned earlier, was created in 1970. So housing finance agencies are mission-based, like Freddie Mac. So right there's a great partnership. And what does Freddie Mac provide the housing finance agencies? If you remember the three things that I mentioned earlier, that our mission is affordability, stability, and liquidity, we provide liquidity to housing finance agencies so they can sustain these affordable programs for low to moderate income borrowers. So what we did, we launched the Hfa Advantage Program, which is specific for lenders to use through a housing finance agency like Catherine's. Okay, you as a lender cannot deliver Hfa Advantage directly to Freddie Mac. Our other programs like Home Possible and Home One, you deliver directly to us. It's a 3% down program, so it's more affordable than an FHA loan, which requires 3.5% down. We allow for 105% total loan to value, so that allows secondary financing, which has a lien on it, to be behind the first mortgage. As far as income limits and education requirements, we defer to the housing finance agency to set their guidelines there. And we also offer charter level mortgage insurance, which also makes this loan more affordable than a standard conventional loan. So housing finance agencies over the past 50 years have made a tremendous impact in the affordable ecosystem and providing, assistance to low to moderate income households. What they affected was really by producing, loans for 7 million affordable homes, totaling $450 billion in financing, which is really, really a tremendous amount. And this is just a quick overview of the Hfa Advantage Program. It's for one unit, primary residences. It can be used for purchase or no cash out refinancing. That is determined, by the housing finance agency. As Catherine mentioned, they are using this program, for purchase money, and they do have a refinance program. There are many housing finance agencies that don't go into the refinance loan business, and they suffered, last year because of the refi boom, and their volume was down. So again, that's really based on how they're chartered and what the mission is at each housing finance agency. We have some lenders in the audience. If you cross borders and you're doing loans in other states, other than Maryland, we do have relationships with the housing finance agencies in Delaware, and also with Virginia Housing, and in the District of Columbia, DC. And we also have a relationship with the HFA in Montgomery County in your state. So that's good to know if you're lending to borrowers in those areas. As I mentioned, it's 97% LTV, 3% down, 105% TLTV. Each loan has to be underwritten through Loan Product Advisor, which is our automated underwriting system. There's no reserves required, but I always recommend if the borrower does have cash in a checking or savings account or any other account, it's always a great idea to put it on the application, because it strengthens the loan when the layers of risk are being reviewed. Like I mentioned earlier, income limits are determined by the housing finance agency, and we have the flexible MI. So this makes for a tremendous alternative to an FHA loan, which is much more costly. And this illustrates the amount of MI that they pay. Okay, if you look in the bottom right-hand corner, in the standard conventional loan, the mortgage insurance for 3% down is 35%. On the HFA Advantage, 3% down, it's 18%. So the savings is almost half. And again, that's why it makes this program, Freddie Mac's most affordable program that we offer. And of course, if the LTV is less, you see the percentages for the MI do reduce. You've heard me mention already that we, are out there to serve the underserved and workforce families. And this is really a great indicator. We got this information from the National Council of State Housing Agencies, which is the advocate for housing finance agencies in Washington. And the median income of single-family borrowers in 2019 for all home buyers was $93,200. For HFA home buyers, it was $50,770. So this is a great illustration on the segment of the market that housing finance agencies really serve throughout the country. And as I mentioned earlier, one of our community missions here at Freddie Mac is to promote more loans to people of color and to reduce the the gap of home ownership between white, non-Hispanic, and people of color. And again, this information was provided by the NCSHA, and it's a look back to 2001, and it shows you on the red line the percentage of loans made to people of color by housing finance agencies versus the market, which is the blue line. And as you can see, in many of the years, housing finance agencies were either at or above, the market in providing loans to borrowers of color. So again, another reason why Freddie Mac partners with housing finance agencies, to achieve, our community mission and affordable goals. Right now, I'm going to go into a market analysis. I mentioned, earlier, one of our main 4 pillars is insights, and I asked our data and analytics team to, give me information with the counties in Maryland where Freddie Mac has the most loans. So again, I can provide this information to you, and this is just an example of what we provide to the industry, and hopefully you'll find this this information enlightening. So what we have here is a population and age comparison table chart, and it has numbers for the entire country, state of Maryland, and we broke it down to the counties of Anne Arundel, Baltimore, Howard, Montgomery, Prince George's, and we also took a look at Baltimore City. And right now, millennials are really driving the purchase money market. So this gives you a good indication of where that age bracket is. And Baltimore City has the highest percentage in your state of 25 to 34 year old. So right there, it's at 18.8%. The United States is at 13.8%. So in Anne Arundel County and Prince George's, and also Baltimore County, you're over that 13.8%. So again, these are just numbers to help you, in setting your selling strategies, and when you're talking to, if you're a lender, your realtor partners out there, and you can share this information with your realtor partners also if you feel this will help them. What we have here is a minority share comparison chart and table, and the major population in Burlington City, or I'm sorry, Baltimore City, and Prince George's County is African American. So if you look at the numbers down below, okay, now the United States is 12.3% African American, state of Maryland's 29.3%. So Baltimore is 27.9%, and Prince George's County is 62%. So those counties definitely will help Freddie Mac and the Maryland DHCD achieve our goals in, bridging that gap that I spoke about earlier. So again, important information, shows really good demographics of, who lives where and where your potential home buyers are. This is an FHA loan share comparison chart and table by minority. And as you can see, on the numbers below, the African American community has a higher share of FHA loans. That's over the average for the United States at 30.2%. So in Anne Arundel, it's 31.1%, Baltimore County 42.8%, Howard County 30.8%, and Prince George's 32.9%, and Baltimore City 48.2%. So, through education and raising awareness, we want to see those numbers shrink. Now, FHA is an important lending program. There's no doubt about it. But it shouldn't be the main, lending program out there in the marketplace. So I'm not here to bash FHA. We need that program in the market. But, we are looking to, educate and raise awareness out there with consumers, to get their credit scores in line to where they can, qualify for a conventional loan and pay less cost on the mortgage insurance side. And also, as I'm sure most of you know, the FHA loan, the insurance is perpetual. It's for the life of loan. And on the conventional side, it does sunset and go away when the balance reaches 80% loan to value. So this chart here is conventional loan share comparison chart and table by minority, and it shows you the percentages of where African Americans, Hispanics, Asians, and white non-minorities have conventional loans throughout those counties. So again, African Americans and Hispanics have lower percentage of conventional loans. And this chart here shows you unpaid balance comparison chart by minorities. So it shows you, really, where the affordable areas are. That's where Catherine's Housing Finance Agency can help, the underserved and workforce families. So again, borrowers in Baltimore County and Burlington and Baltimore City. I keep saying Burlington City because that's the high school I went to. I'm sorry. That's just my New Jersey-ness coming out. But you see borrowers in Baltimore County and Baltimore City have higher unpaid balances. This chart here is average borrower income comparison chart and table by minority. So again, it shows you, where the median incomes are, where the affordable areas are that you can focus on. And again, if you're a lender, please share this, with your realtor out there who refer business to you, because we really think, this will definitely help them. And this is a very important chart here. It shows the owner occupancy rate. And as you can see, Baltimore City, there are more renters than homeowners. And now as far as, in the United States, the renter occupied is 34.3%. So in Baltimore County, Montgomery County, you're close to that. Prince George's County, you're over that. And in Baltimore City is way over. So Anne Arundel and Howard County, it's indicative they're more established and there's less renters, but that doesn't mean that there's no potential home buyers there. So if your realtors are, in those particular counties, this is great information to share with them. And this is the average credit score comparison chart. And you see in the United States, the average credit score is 694. And look at the state of Maryland, you're right on 694. So that's a great credit score to have throughout your states. Counties that are above the 694, you see Anne Arundel is 705, Howard is 730, and Montgomery is 720. So they're great credit scores for conventional loans. Baltimore County is not far behind, it's at 691. And Prince George's County is 656 and Baltimore City is 645. That's going to be an indicator right there that loans are going to go into FHA because of those credit scores. Now, it's our job as, counselors and lenders and realtors to help people raise these credit scores. So, through education and awareness and financial literacy, we need to get those credit scores up because we need to get the borrowers in those areas, more focused on, conventional loans and being approved for them. So, and again, as I mentioned earlier, one of our main pillars was resources and tools. And I really recommend to all of you, sign up for our subscription center. Freddie Mac's not going to spam you and give you, bad information or sell your email address. This will keep you in the know with really, great industry topics, news from Freddie Mac, program changes, and everything that will help you from an education standpoint. So again, I'm providing a copy of this presentation to you, so you don't have to jot down that long, web address there. So you'll get a copy of that. But I really highly recommend that you sign up for this. One of the greatest tools that Freddie Mac provides is the Credit Smart Financial Education Financial Literacy Tool. This has been around for 20 years, and it's a curriculum that can be done online. There's 12 modules, and as I mentioned, financial literacy really isn't being taught to young people that much anymore, and really, it behooves us as industry experts to really help them understand what's available to them. So it's an interactive platform that goes through credit management, money management, homeownership. And another great thing that Freddie Mac offers is that you can become a certified Credit Smart trainer, and that what that will do for you is really put you in the forefront in your community as a community leader. And you can do these sessions at churches, in your office, community halls, fire halls, take it to the schools. And I have gotten a lot of positive feedback from people that have become Credit Smart certified trainers, that they've gotten a lot of positive reviews and a lot of referral business from this. So again, you have my email address. If you're interested in this, I can send you more information, and I can also make the introduction to the managers here at Freddie Mac that manage this program. In the fall, they are going to have their train-the-trainer programs for this. And as a module of Credit Smart, we have Homebuyer U, whereas Credit Smart is a total financial literacy course. Homebuyer U is specific to homebuyer education, and this is 6 modules. I know my slide here says it's offered in English. I'm very proud. We just broke it out in Spanish, so it is available in Spanish. And I highly recommend that you take a look at this, get involved with it, and if you want to become a trainer, please let me know. So with that, I want to again thank you for tuning in today. I know we're all busy, and we have a lot of loans to approve out there and process, and it's been my pleasure sharing this information with you. Amanda and the board have been kind enough to invite myself and my colleague Jim Clement back in June. We're going to do a deeper dive into HFA Advantage, and also our automated underwriting system, LPA, and with the changes that have occurred, and also the changes in IRLA and ULAD. So I think that will be a really, really nice session for your loan originators and your operations personnel to hear from our subject matter expert, Jim Clement, on those subjects. So with that, I'll stop sharing my screen, and thank you, and turn it back to Amanda.
Great. Thank you so much, Jim and Catherine. We do have a couple more minutes. Does anybody have any questions? Just feel free to unmute yourself if you'd like to speak.
Hey, Amanda, this is Mike McNamara. On behalf of MMBBA, I would like to thank both Catherine and Jim. So, great session, very informative, and I'm sure everyone got a lot out of it. I did personally. So thanks again for your time, Jim and Catherine. Very good.
You're very
Thank you
welcome,
so much
Mike.
for all your support. Thank you.
Any other questions or comments?
Someone did have a question, but I typed it in the chat box. It was a question referencing assets. So I did answer it, but I'll just say, if the question was, if somebody had more than 20% of the liquid assets, my advice is to always reach out to our CDA supervisor of underwriting, Debbie Connor. I put her email in the chat, as well as Carl Metzger, our operations manager. I put his email in the chat. After you discuss it with them, if they feel as though it's not too excessive of the 20% sales price, then they may very well allow it to pass. They would instruct you to have your processor or underwriter do a form called the asset test and they'll tell you to go ahead and send that in with the loan file. Or again, maybe in their conversation with you, they're going to say, oh my God, no, they have way too much money. This program is not a good fit. They don't qualify. So I wanted to at least share that, but I did type everything that I just said to you in the notes.
Thank you. And then Jim, it looks like somebody might have sent you a question into your chat. If you could look at the bottom.
Yeah, it's from T. Cumpston, and it says, find doing the automated system LP and DU with clients under 680 scores most likely will not approve them. So how is this benefiting lower score clients to get approved to do, and why we're having to do FHA all the time? Well, again, Freddie Mac, and I can't speak for Fannie Mae DU, we do not have a minimum credit score. When the information is put into the automated underwriting system, it's analyzed on a layering of risk. And if you're seeing that people aren't being approved under 680, it's because the factors of the layering of risk. You can always, if you have a question on an LPA finding, you can always contact me, and I can get you in touch with the right people that can do a behind the scenes look at the LPA findings. And again, as I mentioned in my presentation, FHA does have a place in the affordable ecosystem for people with lower credit scores. So I'm not discouraging if you get someone that doesn't qualify for a Freddie Mac loan, not to do an FHA loan. If that's what they qualify for, that's what we have to approve them. But again, my theme was to educate and raise awareness and do financial credit repair for people to get them so where we can get their credit scores higher into those levels where they're 700 and above, and we're really not going to have any jeopardy of them not being approved.
Great. Thank you guys so much. And just to let everybody know, I will be posting the Jim's PowerPoint as well as this recording on the MMBBA website. That's available to all of our members. If you're not a member, there is a way to join MMBBA on the site, and we would love to have you. If you have any questions, feel free to reach out to me. I'm at info@mmbba.org, but otherwise you should be able to find it in the helpful links section after you log into the website. All right. And thanks so much, everybody. I hope everybody has a wonderful day and enjoys the Memorial Weekend.
Yes. Great Memorial Day weekend, everybody. Thank you.
Thank you.